Good morning, welcome to the Phoenix Blue update for Friday the 17th of March. I'm Tom Colley and I'll talk you through the markets today. Well, the end of a big week. We've had the FOMC raise the rates by 0.25%, very much as the market anticipated. We had the Bank of Japan telling us that they would continue to target 2% inflation, maintain their QE program and what they call their YCC, which is yield curve control policy, until that 2% is achieved. They're currently looking at an inflation rate of about 0.4% and have had very great difficulty raising that rate over the last decades. So that would suggest that that would be a significant period of time before those policies came under review. We also had a Bank of England announcement and a SNB Swiss central bank announcement this week. So it's been a busy week, but very much dominated by the FOMC with light liquidity before and very much potentially today after what's been quite a big and significant week. Let's start off by looking at news items individually that we had yesterday. Overnight we had negative employment and unemployment data out of Australia. We then had the Bank of Japan rate decision. Rates still held at the negative 0.1% rate. I've already really mentioned what they said in the press conference, which was they will continue to pursue 2% inflation, which for them is a very high target. Suggesting that they will continue to ease with both QE and their yield curve control policies until that 2% is reached and sustained. So still very much a dovish statement out of the Bank of Japan. As expected, the SNB, the Swiss National Bank, remain ready to act, but we very, very rarely see any action actually happening when they report their rate and their policy assessment. When they do make changes, they tend to be without notice and between events. So very little was expected out of that. The contrast to that being the Bank of England. As we anticipated, the MPC held the rate at 0.25%. No surprise there, but the surprise lay in the MPC official bank rate votes. The surprise being that one member of the 9 voted to raise rates. You can see previously at the last meeting all 9 were in favour of holding rates. The forecast was that all 9 would be in favour of holding rates again, but that surprise move by one of the MPC members suggesting that they believed a 0.25% rate rise would be appropriate at this moment in time, or maybe acknowledging that the 0.25% rate rise that happened immediately following Brexit was in fact more than was necessary. When we come to the pound chart, we'll see that had quite a significant move on the pound yesterday just because of that unexpected event. Okay, also coming out, we had building permits from the US coming in slightly under forecast. We had the manufacturing index coming in ahead of forecast, and then unemployment claims, for the sake of argument, bang on what looks like a pretty consistent number, previous, forecast and actual. Looking forward to today, not a great deal of views. We have the G20 meetings today and tomorrow, Saturday, manufacturing sales out of Canada, and then consumer sentiment coming out of the US at 2 o'clock UK time. As I've already said, I think we're going to see somewhat of a liquid market today. Trade cautiously. I would certainly not be trading much after mid-afternoon and looking to get trades closed off for the weekend, as I've said, because I think today will be a day of reflection and the markets absorbing what's happened this week and profits being taken. Okay. So we had his dollar index, we had the FOMC increasing rates, but despite that, we got a big sell-off on the dollar index here. We saw dollar weakness, we saw it follow through yesterday as well. Here on the dollar index, we're down at a very key level. This is the $100 level. Why did we see this big sell-off? Well, it was very much the classic buy the rumours, sell the news scenario. The forecasts, the predictions, everything was almost certain that we were going to get a 0.25% rate rise. We were already expecting 2 further 0.25% rate rises from previous FOMC information. They reiterated that that was still the case. So we got exactly what it said on the tin. We got exactly what we expected. The markets had already priced that in. So having priced it in, all we saw was traders taking profits or being disappointed by a lack of something more positive. Now, in principle, we would expect this to be a temporary pullback for dollar strength. One way to look at it is it will give us a better position for entries going back towards the long side. Our bias still very much remains, or a longer term bias still very much remains dollar strength this year. Why? Well, we come back to the central bank policy divergence. In this box here, we've got the current central bank rates as of yesterday. We've got the US rising from 0.7 to 1%. If you look at where it now stands in the hierarchy of interest rates for currency pairs that we trade, you can see, okay, against the Swissy very negative, but let's look at the more major economies. The Japanese economy, negative interest rates. The Euro economy, 0. The pound, 0.25. Canada, 0.5. And all these economies are not talking about raising rates. Okay, we had the comment, or we had 1 vote out of the pound, but it was 1 vote out of 9, and in itself on the longer term wasn't that significant. By the end of the year, if the Fed follow through with just 2 rate rises, then they'll be up alongside Aussie and New Zealand. Now, these rates have consistently been ahead of rates elsewhere right since the crash of 2007. We'd expect these to potentially be on the high side relative to US rates anyway, but what we're going to see is US rates catching up, and none of these other economies are talking about rate rises. Some are still very cautious, some are talking little more than wait and see. But what we're going to see is the US rates potentially rise relative to all these, and it's that relative levels of interest rates which is why our bias is long the dollar. Bearing in mind higher interest rates attract money to a currency, and the currency actually generates it. Holding that currency generates more income, or in case of the comparison with the yen, for instance, and we're talking the banks and institutions here, it generates income rather than cost. So we should in principle see a move over to the dollar. We've got a picture of rising rates. It's going to be, again, at each meeting when we have rumours, etc., we're potentially going to get the same picture as we just had, unless the US economy picks up and we start looking at a further 3 rises or more this year rather than the 2 that's predicted. But doesn't change our bias whatsoever. We've had a short-term pullback in the market, but that's simply because what the FOMC has said ahead of the meeting, the data we've seen between the last 2 meetings made yesterday's rise inevitable in the market's eyes, so it could only be disappointed by getting what it expected. If it had got anything more, then I'm sure we would have seen the dollar back to the long side. Okay, over on the yen, we saw a pullback through the meeting of the FOMC result on Thursday. Yesterday, however, we're not seeing such a strong move to the downside as we saw on the dollar index. The reason for that is bear in mind the dollar index is 58% weighted in favour of the euro and only 13% in favour of the yen. So this is maybe a purer vision of actual dollar strength through yesterday. Yes, we got the sell-off. Then basically we had a rejection of the level through here yesterday, and that picture there at this moment in time after yesterday, that rejection gives us the impression that we could have the dollar back to the long side. If we look at the euro chart, we saw follow through there as we saw to the downside on the dollar index. We had some positive data from out of Europe in recent weeks. We had Mario Draghi suggesting or giving a relatively hawkish statement for the ECB. However, we still don't see rate rises until at least the end of the year, when the QE program, or the current QE program, comes to an end. They are, as of this month, buying 60 billion euros of bonds rather than the former 80 billion, but that was a pre-planned production and was a reduction in the monthly purchases, but was an increase over the time span. They extended that through to the end of the year as well. So in actual fact, in terms of the actual volume of purchases within that agreement or that commitment, that was actually an increase in bond buying, but just over a longer period at a slower rate. So again, although we are currently, we've got a bullish stance in this market, we have got this setup with potential inverse head and shoulders on the euro, which is reflected by a potential head and shoulders to the downside on the dollar index. We still have a key level through here at about 108. This is the neckline of that. If we do see a break of that, then we could potentially see this inverse head and shoulders play out. Bearing in mind what I've said about central bank policy divergence, on that basis we don't see that. However, as we're all very aware, we have a lot of political things going on. To be fair, all this year we had the results of the Dutch election, which in isolation wasn't so significant, but the fact that the Centralist Party retained power there ahead of the anti-EU, anti-immigration party, while reflects well or reflected on the potential results of the bigger French and German elections during the next few months. So again, reasons to be short-term bullish on the euro. Will we break this level, or are we going to see our bias play out? Clearly, because we've got that bias, we still believe the bias will play out. But if this level is broken and a comparable level is broken on the dollar index, then we will have a medium-term change of view with a view to the head and shoulders and inverse head and shoulders playing out on those charts. Over on the pound, well, we said we obviously on Thursday we had recovery on the pound here based on that dollar weakness. We had follow through yesterday, aided by dollar weakness, but more, that move there was more about, it all happened instantly after the rate announcement from the Bank of England, and that rogue MPC vote was acknowledged in that there was a member willing to raise the rates against all the other 8 members who voted to hold rates. That in itself was a surprise. We saw a reaction to that which we would have anticipated. That reaction potentially was slightly on the large side because we're currently experiencing weakness on the dollar. Over on the Aussie, well, we're up at what's clearly a key level here. We've got a trend line coming through here. We've got a commitment of traders extreme signal. We had a really significant pullback through the dollar weakness back up to this level. The Aussie had been quite strong prior to this breakdown the week before last, and was holding out against dollar strength quite well. It has recovered more than most, so suggests that that picture is still in place. It looked like the buyers here had simply given up the fight, but they've come back in again, and we've had a strong move to the long side, but clearly we'll be looking to take this market back to the short side as and when dollar strength kicks back in. Over on the Kiwi, well, again we saw the dollar weakness. We saw a response to that. The Kiwi gained on Thursday. We have, however, on Wednesday it gained. On Thursday we had a return to the short side. The Kiwi has been significantly weaker than its Antipodean partner, the Aussie. If we see this move down here, constant bearish continuation bars to the downside. So this would be what we anticipated, or what we would have anticipated. We've seen the reaction. We're now looking again to the short side, and we'll be looking for opportunities to get into that market sooner than rather than later, based on our analysis over the weekend. Okay guys, so that's really a summary of where we're at. At Phoenix Blue, we've had a quiet trading week. We were waiting for the FOMC decision. The FOMC decision was what we expected. The dollar pulled back, which wasn't really what we were looking for in terms of immediate trading opportunities. Subsequent to that, we have really ostensibly been out of the market, waiting for the market to decide what the next move is. Our analysis at the weekend is critical. Anything we've done in the intervening time, or anything we'll consider today, will be purely intraday. But as I say, I do expect somewhat of a hangover day. So in principle, we'll be looking ahead to next week for our next moves. Okay guys, so time for a rest for the weekend. You will have popping up here links for our website. If you're not subscribed to the YouTube channel and you don't get an email every morning to say this video's gone out, please click on the logos that will be appearing on here. So again, have a great weekend. Let's get our analysis done, and let's hope we're looking forward to a lot of nice trading opportunities next week. Okay, thank you and goodbye.